Whether you're thinking about buying a home or selling a home,
Trish Sales ATL can help.
with the current Atlanta real estate market, buyer and seller opportunities are better than ever.
Thank y'all so much, but I'll take it from here. Sellers, this is your market. It's time for you to get off of that fence and put your home on the market and get it sold to my buyers who are waiting for you to list your home. I'd love to earn your business, so please give Trish a call at Keller Williams Realty Buckhead, 404-604-3800, or text or call 404-819-4495. Please also visit my website at TrishSalesATL.com. Let's talk about how I can assist you with achieving your real estate goals and making your dreams a reality.
List your house with our mommy at TrishSalesATL.com.
Here we are. Got it. All right. We'll get this going here for us. There is no sound. Well, I know other people have heard. Where's the chat box at again? There it is. Others have indicated. Speakers. System. All right. Going to present in Teams. That's a new thing. I haven't seen that before. Let's see what that does. Oh, it failed. That's disappointing. All right, just one moment. I will be ready in just a moment. Here we go. Let me hit the share screen. All right, so I believe you all should be able to see the screen with the couple holding the keys and looking very excited because they're buying their first house. So if somebody could give me a thumbs up or something and just confirm that you can actually see that screen would be great. But that's what I believe you should be able to see. I got a thumbs up. There we go. We're keeping moving then. All right. So I appreciate you guys all coming on here kind of last minute. I kind of decided to do this a little last minute. So I'm glad you're here. We're going to talk about the lending process, the buying of a house process. And then we're going to talk a little bit about the down payment assistance programs that we have available here at Regions, so that you can see if any of those are something that you would be interested in and could help you become a homeowner. 2024 can be your year, and we just need to get the right partners in place to make that happen. And I know that some of you on here are realtors, some of you are agents, some of you are realtors, and some of you are prospective home buyers. So we have a good group here. Any questions that you have along the way, please feel free to type those into the chat so that we can address those. I will probably do my best to ignore those until after. I find that that's the best way to do it. So save your questions, type them in the chat, and then when we're done with the entire presentation, we'll go back and answer all the questions, and I will stay here until everybody has all their questions answered. Okay. So we do need to tell you that this is not intended to be legal, tax, or financial advice. So I am not a tax planner, I'm not a financial advisor, or any sort of a legal advisor. I'm a mortgage loan originator. So while I can help you and guide you through that mortgage process, I am not giving you legal, tax, or financial advice. You need to go specifically to those individuals for that type of advice. So we're going to discuss the pros and cons of owning a home, the basics about mortgages that you need to know before you buy a home, what's involved in the application process for the mortgage, and what are the available options for down payment assistance. So being here today is a huge step in the right direction for home ownership, right? Because you're saying, this is important enough to me to take time on a Wednesday evening to listen to this woman pontificate about mortgages. Mortgages are just a fancy way of saying house finances. We'll give you a loan and that will help you to purchase the property. And that is just, mortgage is just the type of loan that we give you. So why own a home? Buying and owning a home, of course, can be a very rewarding experience if you are properly prepared and you know what to expect and to make the right financial decisions. I'd love for you each to type into the chat, what do you think the benefit of owning a home is? What kinds of things do you think about when you're like, I want to be a homeowner? Or for those of you who are on the agent side, what is it that why are you in this job? Why do you do this work? What's important about it for you? And I'll tell you that for me personally, I've been doing mortgages for about 30 years now. And I know it's crazy, but true. And I do it because I love the idea that we can all have a part of the American dream. And isn't that what homeownership is? It's the quintessential American dream of owning your own piece of property and having your own building that you live in with your family, and no one can take that away from you. And it's pretty, some people might say cheesy, but that's really what's important to me. Is I think having a home creates so many benefits in our communities, and I love that I get to help people do this because it changes lives and it changes the generational trajectory of families. And so it's pretty fun for me to be able to do this. So we do have one answer from Miss Kaya. She said stability, and that is definitely a good reason for home ownership. We have stability, we have a sense of community, we have pride of ownership. Once you get that home, you can paint it and you can redecorate it and you can rearrange it and you can renovate it and you can do whatever you want to with it to make it truly yours and to make it that property that is really the comfortable place for you. Obviously, there is some advantage financially as well. You're purchasing a home, which is the asset. And as we know through the years, historically, homes in America appreciate in value. There might have been there are a few bumps along the way of that, but overall, homes do appreciate in value. So there is some investment in there that you can have as the appreciation grows and as you pay the loan down, so your equity share grows. The interest that you pay on your mortgage could potentially be tax deductible, so that's something to consider. And then, of course, as we discussed, you do have the ability to make changes to the property. So here's some basic numbers to kind of look at owning versus renting. And I will tell you these numbers are a little outdated, so you can multiply them as you need to make them a little more accurate for 2024. But this is based on purchasing a property at $110,000, mortgage payment being $800 a month, of course, assuming that your rent is the same $800 a month. And then along the bottom here, you can see we're discussing annual appreciation at 5% and an annual rent increase at 3%. And I think the appreciation is probably still pretty accurate, 5%. I know we had a couple of years where it definitely went up by way more than 5%, but I think that overall. Historically, it's probably a good number. And of course, rent increase, we know over the last 3 years, rental increases have gone up about 150%, I think. At least the last thing I remember reading was about 150%. But we also know that the last 3 years have been an exception to the rule when it comes to what's happening economically in our country. So if you have an $800 mortgage payment, and we compare that to, and the homeowners here in the green column, we compare that to the renter in the blue column, who is paying $800 a month in rent. So we're starting off comparing apples to apples, right? In that first year of home ownership, you're going to pay $9,600 for your monthly payment. Of that $9,600, $5,188.38 is going to be the interest on the loan, that you could potentially deduct that from your taxes. And then you're also going to pay 1 year of property taxes, which also could potentially be deducted from your income taxes. And in those payments, then you're also going to build in equity of $1,697.38 while you're making those payments every month. So when you take out those deductions and you add back the principal and all of that, or the equity build, you actually come out ahead. Come out with a cost of only $1,514.24. So a little bit over $100 a month to own your own home. Whereas if you're renting here in the blue column, you don't get any of those deductions. And your first year effective cost is the same, $9,600. As a homeowner, after 10 years of ownership and paying down that equity principal payment, you would be building your equity to the tune of $21,205.34. And based on our 5% appreciation, you would actually be building up over 10 years more than $5,625. Now remember, this is on a property valuation of $110,000. And I would think that the agents on the line tonight would tell us that you would want to multiply that by 3 to get a decent property, $330,000. It's hard to find anything under $300,000 at this point in our area. It's possible, but it's hard. I've got loans in the pipe right now of people doing that, but definitely double, if not triple, these numbers in order to be more accurate. And so after 10 years, you've actually built in wealth for yourself to the tune of $26,830. And all you were doing is making your housing payment just like you would have if you were renting. You were making your housing payment, but it actually cost you $110,028 as opposed to building wealth of $26,830. So a big difference there, just financially. But there are also risks and responsibility to home ownership. We know this, right? Because what do you do right now, for those of you who do live in a rental property? What do you do right now if that furnace does go out? If the water pipes freeze? If the AC doesn't come on in the spring and the summer? You call the landlord, you call the management company, you call the manager's office, and you have them send a technician and they take care of it, and there's no additional cost to you. But as a homeowner, those responsibilities fall on you. So you need to make sure that you're going to be able to handle that. And there's ways to mitigate that. Home warranties is one way. Understanding how to maintain, just doing some basic maintenance on your home, which is a great reason to attend your home inspection when you have one. Because I've been a homeowner off and on through the years for many, many years. Yet when I go to a home inspection for a new home that I'm buying, I learn a lot about that house, a lot. Because the home inspector is going into places in your home that you may not ever go into, but he or she is doing that because that's his job to do. And then he's going to show you what he's found in those areas and understand better how to manage your home properly. So another risk, of course, is there could be some property depreciation. It's not a guarantee, just like there's no guarantees in life except for death and taxes, right? There's no guarantee of appreciation. And while the overall through the years has been that your property will appreciate, and usually will appreciate to the tune of about 5% per year or more. It has had times, there have been times through the years during the Great Recessions and Depressions and so forth, that property value has depreciated. The depreciation, while it may happen quickly, usually turns back around quickly as well. So that's pretty uncommon that it would stay low. And then also, of course, if something happens in life, lifing, as some people say, where all of a sudden you have to sell your home quickly, maybe due to financial concerns or relocation, maybe your parents are elderly and they live 3 states away and they really need to be with someone, but your home is really only fit for 2 people or not fit for them because it's a 2-story or a 3-story. So maybe you're going to have to sell your home quickly and buy a new one. Then of course, those are the risks that you have. It's a little bit more complicated to switch homes when you own a home than it is when you buy a home, when you rent a home. So just make sure that you're going into it with all the right information, that you're doing your homework and your research, which is what we're doing tonight. That's a big part of what we're doing tonight. Buying a home, of course, can be a good investment. Just remember that you need to be prepared for both the joys and the responsibilities of home ownership. And let's explore the big question of, are you ready to buy a home? So evaluating your current income and expenses to gain a clear picture of what you feel comfortable paying for a monthly mortgage is a really good idea at this point. So you may currently be paying, let's say, $1,800 a month in rent. And while that might be painful to you to pay that for rent, is it a dollar amount that you're comfortable paying for a mortgage? Because then you'll be using it to build your equity in your home, to build your appreciation there. So, but the other side of it too is maybe you're paying $1,800 a month of rent and you're comfortable with that, but since you're going to be buying a house, you'd be comfortable spending $2,800 and we can get you approved on that. So these are questions that I do commonly ask in that very first conversation, is to find out what is it that you're comfortable paying for a monthly payment. Knowing your credit score is good, and using a tool like Credit Karma or Credit Sesame or one of the credit cards that you have that offer your score, that score is a good starting point. I'm going to ask you questions when we very first talk, and some of you have already talked to, that just trying to find out exactly where you are right now so that we can make a plan to get you where you want to go. So I'm going to ask you about your credit. And yes, Credit Karma and those other places are giving you either a raw score, which is what you get from Credit Karma. There's no risk built into it like there is when I pull a score, because then they put in the mortgage risk. Or it's going to be from like the credit cards or another bank organization is going to give you a score, and that may or may not have any kind of risk algorithm built into it. So you're right, the numbers are not going to be exactly the same, but it gives us a really good idea of where you are and what the next steps would be. If you don't have access to your credit report and you don't have any idea what your score is, you can always get access to your credit report. You can go to freecreditreport.com and you can get a copy of it. You can go sign up on Credit Karma and do it for free and get it there, and get an idea of where are you. Make sure that everything on there is correct. And if you have large amounts of things like maybe Latrina, can you mute your line for us, please? Maybe she did. because it stopped. So that's good. Okay. So anyway, what I was saying is about, your credit report, to know what's on there. Make sure that you take care of things that are on there, and get things cleaned up as much as you can before we talk. But if there's still stuff on there and you don't know what to do with it, we can work on that together too. All right. So next step is looking at your finances to see if you are prepared. So this, again, these numbers are a bit outdated. They're not 2024 numbers, but it gives you an idea of what we would be looking at for what you can buy. What we're doing here is, this is an idea of your loan to value ratio, your affordability by lending ratios. So what we're going to do is we're going to look at your gross monthly income. So before taxes and everything else is taken out. And we're going to, for the payment, the mortgage payment ratio, which is the PTI or front end ratio, we're going to look anywhere from 33 to 45% of this monthly income, okay, of your gross monthly income. And then your payment for the house can probably be no more than that. And the reason it's 33 to 45% is because different loan programs have different rules about what those percentages need to be. And also, depending on where your credit score is, some loan programs say, well, if your credit score is high enough, we'll actually let you bump that up by 5 more points. And so you can go from 40 to 45 or 45 to 50, depending. So there's that as well. Then the other ratio that we're looking at is what we call the back end ratio, or the total debt to income ratio, where we take your current debt that you have and those monthly payments, we add it to the new mortgage payment that we're going to have, and then divide that into your income to come up with the total debt. And those range anywhere from 43 to 56%. In some certain situations, it can go up as high as 65%. That's very limited situations. So I would say 56 is your top end. But then you have some idea of where you would be at. So remembering that your debt, when you're calculating that, it does need to include car payments, student loans, child support if you're paying that. If you have any of those Affirm or Afterpay or Klarna type of buy now, pay it later things that are going out through your checking account, when we see those on the bank statements, we're going to ask you about the balances on those accounts. So for 2 months before you're ready to buy a house, and for 2 months plus through the end of the closing, don't do any of those, okay? They're not all they're cracked up to be, unless you truly need to have that money split out over 4 payments. Don't do that. Just pay for it, be done, move on. But if we see those types of things in your account, we will be asking for more information about them, because that is something important. It's considered a debt, so we need to make sure we're calculating everything correctly. The debt ratios do not include variable spending like groceries, utilities, your phone, any streaming services, car insurance, things like that. That's not included when we talk about that. So this is what we're looking at in terms of how the underwriter is making these assessments on your file. So what do you know about mortgages? Well, the big joke in the business is if that person doesn't even know how to spell mortgage, and that's because, see this G and this G, there's 2 of them, boom, boom. A lot of people don't even pay attention to that. That's the joke in the industry, that you're no good at it if you can't even spell it. It's a terrible joke, but that's the joke. So we're going to talk about what is a mortgage, what's included in the monthly payment, what's an escrow account, and what is the difference between being pre-qualified and pre-approved. And if you want to answer any of those questions before we get into them, feel free to throw your answers in the chat. And I will just say right now, as a quick reminder, if you have any questions as we're going along, please do put them in the chat so that we can address those at the end of the presentation to make sure that everybody gets all their questions answered. So what is a mortgage? Anybody have an answer to this one? Throw your hand up or throw it in the chat. Start typing so I know you're looking or doing that. Anybody know what a mortgage is? Not seeing any activity. So we're going to go ahead and answer. A mortgage is a type of loan that is secured by real estate, the home that you're buying. So unless you're paying cash for your home or exchanging it from some other consideration for the home, you're going to need a mortgage. And with that mortgage, you're basically promising to pay the lender in monthly installments in exchange for the money used to purchase the home. Of course, if you stop making those payments, you'll go into default, which means you failed to meet the terms of the loan and the lender can take the property back. And in Georgia, you will hear when you go to closing, because all of you are going to go to closing, you will hear the attorney say now several times, this document here says no pay, no stay. Basically, that just means if you don't pay your mortgage, you don't stay in the house. And in Georgia, we are a non-judicial foreclosure state, which means that it's going to happen pretty quickly that you won't be able to, that your home is going to get turned over into a foreclosure process and that you'll lose it. So if you get yourself into a situation and you're having trouble with meeting your mortgage payment, if I was your loan officer, you could call me. We can talk about your situation, see what we can do. You can also call your lender. And it's important to know that because as much as some people might think that banks want to take the properties back, that is absolutely 100% not true. We are not in the business to be property managers. We are in the business of lending money. So we do not want to own property. We want you to own the property and we just lend you the money and you pay us back and then we'll go lend it to somebody else. So talk to the lender if you find yourself in some struggles. There's also other resources out there, housing counseling and so forth. So if you're in struggles with that, definitely let's talk about that and get you set up with some more success. So types of mortgage products. So tonight, I don't know why tonight. These are the mortgages no matter what. It's not just tonight. We have either a fixed rate mortgage or a not fixed rate mortgage, also known as an adjustable rate mortgage. What that means is that the interest rate on the mortgage is fixed. So most mortgages are 30 years. You can do them for 10, 15, 20, 25. There's some companies you can get 40-year mortgages. And I even heard a rumor a couple of years ago about a 50-year mortgage. And I thought, oh, geez, that's a lot of pressure for someone 25 to think about that. But the difference between the two is that the fixed rate mortgage, once that interest rate is locked in, it stays locked. It stays at that rate through the entire life of the loan. The rate does not change, okay? Your payment might change, and we'll discuss that a little bit in the next slide, but the rate does not change. On an adjustable rate mortgage, the rate can change, which of course will then make your payment change. But on adjustable rate mortgage, there's usually a fixed time frame of 5, 7, 10 years. It's usually overall of the life of the loan is 30 years, can be shorter, but usually is 30 on an adjustable, also known as an ARM. And the 5, 7, or 10-year period, which is the initial period, is when the rate is locked in and it doesn't move. Okay, so whatever you signed for at the time that you close the loan is going to stay that amount for 5, 7, 10 years, depending on what kind of adjustable rate you get. Once you get into that change period, then after the 5th, 7th, 10th year, what have you, you'll start getting notices from the bank every 6 months or a year, depending on how your loan is set up, as to what changes are going to occur in your mortgage payment for the next period of time. And depending on how your loan is, it could be every 6 months, it could be every 12 months, it could be every month. So those are things that if you are looking at an adjustable rate mortgage, you just need to know what those rules are so that you can predict and make the best option, make the best choices for you. Now, there are other categories of mortgages, and many of you have probably heard things like conventional or government loans. Conventional loans are the ones that are provided through Fannie, Freddie, those agencies that are government-sponsored entities. But the government loans are actually through Federal Housing Authority, the Veterans Affairs, or USDA, the United States Department of Agriculture, I think it is. And so those offer some different types of mortgage insurance and government guarantees in order to allow you to do something with a lower down payment, still a very favorable rate, and then get into the home so that you can start building up your equity and your wealth. So what is typically in a monthly payment? Typically, you have these four things. You have the principal, interest, taxes, and insurance. And there's a couple different kinds of insurance that you'll see in there. So the principal is just that, where you borrowed $150,000 and you got to pay it back. So when you make your mortgage payment, that chunk that goes to the principal is actually pushing that $150,000 down every time you make that payment, which is the part that's building the equity inside the home, because now your house maybe is worth $200,000, you borrowed $150,000, so you already have $50,000 in equity. But every time you make a payment, then you have $50,100, and you have $50,200, $50,300. So that's how that works. Of course, there is interest that you're going to pay, because that's how we make our money. Is we charge you to borrow the money used to purchase the home. The taxes are going to be the property taxes. Typically in Georgia, it's county taxes. There may also be some local city or municipality taxes. In the city of Atlanta, they have the sanitation and sewer taxes as well. All of those will be combined into your mortgage payment. And then when your taxes come due, the bill will go to your lender, and your lender will make that payment directly to the taxing authority for you. You do not have to do that. You may very well get a copy of the tax bill. And if you're not sure if your lender got a copy of it, all you got to do is call them up and talk to them about it, and they'll confirm for you whether they have it. Most lenders do that all electronically with the counties at this point. Back when I started in mortgages, which those of you who are here know was 30 years ago, my job was to reconcile private mortgage insurance, which is something that gets paid on many of the bills many of the loans. It gets paid every single month. And that was reconciled through the dot matrix print outs that every morning I come into work, and there'd be a stack of these big binders that, the huge papers that then I'd have to go through and make sure the payments were all made. And if they weren't, then I need to mark it and then report it so that it was taken care of on the back end manually. So, but now they do it all electronically, so it's much better. So the next part, so the taxes is all done that way. And then the insurance, there's a few different kinds of insurance. So the first kind is your property insurance. So that's going to protect your home in case of disaster or damage, like fire, tornado, storm knocks a tree over, a car comes crashing through your front window, the Amazon driver doesn't stop and hits your garage, whatever it is, okay? That's what the property insurance is for, also called homeowners insurance. But there's also flood insurance if you're in a flood zone, if the property is in a flood zone. We don't have a lot of those around here, but we do have some. And that would be also escrowed in. And then the other thing would be private mortgage insurance, or the government guaranteed mortgage insurance. Private mortgage insurance or mortgage insurance is required on any loan that is going to go in the secondary market, which is something you don't really need to know about. It's how businesses make money on the back end on your mortgage loan. But mortgage insurance is required when you have less than a 20% down payment. So if you're doing a 3% or a 3.5% for an FHA or 10%, what have you, you're going to most likely be paying mortgage insurance. If you are doing a conventional loan, that is going to be private mortgage insurance, and there's multiple companies that we quote that out with, and we get the best deal for you. The mortgage insurance protects the lender. It does not protect you, it protects the lender. It's protecting us to make sure that you make your payment so that the loan continues to move forward. If you default and stop making your payment, then we put a claim on the mortgage insurance to make ourselves whole, because now we've had to take this property back. We've had to incur all the costs of the foreclosure proceedings. Now we own the property, so we have that overhead, and then we're going to try to sell it. Who knows what condition it's in, all of that stuff. So that's what the mortgage insurance does. On government property, government loans like FHA, VA doesn't really have monthly mortgage insurance, and USDA, there is mortgage insurance involved in that. Those are typically for the life of the loan, no matter what equity position you're in. And it is important to make sure that you understand that when you get those loans. And in some cases, which this is extremely rare, your mortgage payment may have homeowners association fees included in it. Most cases, you are going to pay those separately. They'll show up on all the paperwork and it'll look like it's included in the payment, but it is not. It's going to be something that you're going to pay separately. All right. What is an escrow account? Well, that's easy. So back here, we had this taxes and insurance, right? Well, when you make that payment every month and you're paying 1/12 of your annual tax bill and 1/12 of your annual property insurance bill, plus the monthly bill on your mortgage insurance, that money has to go somewhere. And that goes into what they call an escrow account. It's almost like a savings account to some extent, where then the money is held by the lender on your behalf. And then when those bills come out for your taxes and your property insurance and monthly on the mortgage insurance, then the lender makes those payments on your behalf using the money in your escrow account. It's not like a savings account in that you cannot collect interest on that money, and the lender cannot collect interest on it either. So they're not making money off of your money, just so you know. But it is a way to make sure that your property is insured all the time and that the taxes are paid, because even if you paid your monthly payment every single month consistently, but the taxes were never paid on the property, the county can come in and take ownership of that property, even though we have a mortgage on it, because taxes are always going to be in first position. That's just the way the government is set up. So we like to make sure that those taxes are being paid on the property, and so that we don't end up and have a default because someone didn't pay their taxes for a couple of years. So, all right. What is pre-qualification? So let's talk about that. Pre-qualification versus a pre-approval. So pre-qualification is the first step, okay? So if you are being referred to me by one of our realtor partners on the phone, or maybe one of you people on the line tonight who have been working with me say, oh my gosh, Jen is awesome, you need to talk to her, to one of your friends, and said, so then your friend calls me up, we're gonna have a conversation. It's gonna be about 10, maybe 20 minutes, depends on how chatty we get. And we're going to talk about things like the credit score that we already discussed. Are you a first-time home buyer, or have you ever owned a home before? And if you did, when? Because if you haven't owned a home in the last 3 years, but you did before that, you're now considered a first-time home buyer again, or I like to call it a born-again first-time home buyer. I'm going to ask you about your income. Where is it coming from? You know, how long have you been on your job? Is it a pension? Is it disability benefits? What have you? And I am going to ask you about where you are today in terms of your savings. What money do you have for down payment, moving expenses, closing costs, utility deposits, things like that. Okay. And once they know those numbers, then we'll talk about what are the next steps. The next step after that, provided the answers to your questions are ones that say, yep, you are ready to go, would be to do an application and give me a few documents, short list, pay stubs, W-2s, bank statements, short list. Once I get that, plus your application, I'll pull your credit report, and then I'll do a quick analysis. And if everything looks good, I can send you a pre-qualification letter. And I usually send a mortgage fee worksheet alongside that. And then we'll talk again and we'll discuss everything so you'll understand it. What that pre-qualification letter lets you do is to take that letter, send it to your agent. The agents here who've worked with me, they know they've received this and they know that I get it out pretty quickly. And that, once you get that, then your agent can actually start really getting serious about the whole shopping part and the actual house hunting, because now we have real numbers. Now we know that you can qualify for a mortgage for sure, and what kind of a mortgage that is, because that is important. It will also give us a better sense of how long we need to be able to get the whole process completed. And so pre-qualification is just a quick look at your overall situation, a pull on the credit. And yes, it is a hard pull in order to see exactly where are you and if you can qualify at this time. The next step after that would be to go ahead and get pre-approved. Now, this is going to be a little bit longer because we're going to actually dig a little deeper. We're going to get verifications of employment. We're going to understand what's going on with your bank statements. If you have some of those Affirm or Afterpay or Klarna type of transactions, we're going to ask you for details on that, documentation of it. We may ask you for some other documentation. If you're self-employed, we may ask you to not only provide the tax returns that you did initially, but now let's go ahead and get a profit and loss statement for your latest quarter. Quite frankly, right now, because most people are starting to prepare taxes for the 2023 year, but they haven't filed them yet, we'll be asking you for a 2023 profit and loss so we can see what your numbers were like last year in comparison to 22 and 21 taxes. So we're going to take a little deeper dive into things, get a little more granular on what we're looking at there, and actually send you some disclosures, pre-approval disclosures to sign to say, yes, you want to move this file into the underwriting phase. So that's what a pre-approval is it actually goes in front of one of our human underwriters and checks off everything that I'm assessed, or she comes back and says, well, Jen, you missed this, because that does happen on occasion. And then that way, when you get your pre-approval in place, we'll issue what's called a commitment letter at that point. Now, a commitment letter is actually something a little bit stronger than a pre-qualification letter because you've already gone through underwriting, right? So now when you go and you're working with your agent on that, your agent knows you've already been through underwriting. So any of the wrinkles that might have been in your qualification portion are either already ironed out or we know we can iron them out already, okay? So then we really only need to do the qualification, the underwriting process on the property itself with the appraisal, the title work, getting the homeowner's insurance in place, and everything else is already pretty much assessed. We know what we're dealing with there. And so that also allows you to move a little faster through the process. And for sellers, once you provide them with a commitment letter, they can feel much more confident in the fact that you're actually going to close the transaction because you've already been underwritten. The big question for sellers is always about you. They know their property's perfect. A title's going to be fine. It's going to appraise wonderfully, the whole thing. They're not worried about that. They're worried about you. So if you can show them, I've already been approved, me personally, my documentation, then that gives them a really great warm and fuzzy feeling. And of course, like I said, it also helps because you don't have to go through the whole, you can go through a much faster process, which may help you win a bid. you know, or maybe because you can close a week earlier, you're going to be able to get a little bit of money shaved off of the purchase price, or maybe a little bit of extra seller paid closing costs to help out. So in order to obtain the pre-approval or the pre-qualification, the first things that we're going to need are things like pay stubs for the last month, W-2s for the last 2 years, tax returns for the last 2 years, bank statements for the last 2 months on all of your assets. So if you have a 401k, IRA, anything like that, either the last 2 months bank statements or quarterly, checking accounts, savings accounts, all of that. And then proof of any additional income, say you're receiving child support, or maybe you're receiving spousal support. If you're receiving Social Security, VA benefits, disability, whatever it is, okay? Whatever income you want us to use to qualify you, that's what we need to see. And then the full application, so then that allows us to go ahead and order your credit report. So again, why would you get pre-approved? It saves you time by letting you search for homes within your pre-approved affordable price range. Because that's the other thing. Often people get pre-approved for a dollar amount that they don't necessarily want to spend. So that makes it difficult because, you know, maybe you can get qualified for $450,000, but you don't want a $3,000 mortgage payment. Okay, well, where do you want your mortgage payment to tap out? $2,000. All right, so then let's look at 250, maybe 300,000. So it also lets sellers know that you're serious, you've already been qualified. And of course, if there is the competition, it can help you out because, again, sellers know you're already qualified and your process is going to be a bit faster. So there's 4 C's of credit we like to talk about. And those 4 C's are capacity, capital, collateral, and character. So capacity is your ability to meet the payments, okay? That's where the debt to income ratios come in. How long have you been on your job? How much money do you make? Capital is talking about the value of your assets and your net worth. How much money do you have in your checking account? Do you have money in a 401k that we can use as reserves? Are you cashing out the 401k? So we won't be able to use it as reserves. Collateral in this case is going to be the property, whatever purchase of the subject property that you're going to buy, that'll be your collateral. If you're doing a car loan, of course, the car is the collateral. And then character is going to be looking at your credit report and how you've managed credit in the past. Have you paid your bills on time? Did you even have credit in the past? Because if you didn't, that's okay. We just need to know so that we can approach that. So those are the things that we're looking for there. Your personal information is going to help us make the decisions about your mortgage application, okay? So obtaining the mortgage, you're going to use these documents that we already discussed. I don't know why I have that in there twice, but I do. Mortgage costs, let's talk about that. So you've been pre-approved, you went with one of our lovely agents and you've found the perfect house and you're so excited. Now what? Okay, well, now's where it really gets real, okay? Because now you got to start putting money on the line. So the very first thing, once you get an accepted offer, is you got to pay your earnest money, okay? So you got to get that sent over to whoever's holding it. Usually it's the attorney who's going to do the closing transaction. You send over your $2,000 or whatever dollar amount it is. The next thing your agent's going to have you do is a home inspection fee, the home inspection. And those charges vary depending on the size of the house. It could be anywhere from $300 to $400, maybe even $500 to do that home inspection. And this is not an appraisal. It's different than a home inspection. The home inspection is to look at all of the bits and pieces and parts of the house, make sure things are functioning properly, make sure that if there's things that need to be repaired, or to even understand where is the main water shutoff, where is the circuit breaker board, where is the water heater, Is the furnace working properly? Is there animals in the attic or not? Things of that nature is what you're going to find on the home inspection. And that needs to be paid for upfront. That usually has to be done in the due diligence period, which is typically a 3 to 7 day period after you get the contract. Okay. The next thing you're going to pay for is those appraisal fee. So the appraisal fee is going to be about $500 depending on the loan program and sometimes depending on the purchase price. If you get into really high purchase prices, often we need to get a second appraisal to make sure that the value is actually there in the property. And that's typically, like I said, $500. And you do have to pay that right away as well, because as soon as we get that contract, that's one of the things we need to order, because we got to get it back and underwritten in time to meet your financing contingency dates. And that is an important part of it. Okay. So down payment. This is the part of the home purchase where you're going to pay cash up front. But saying it that way is a little confusing because you're actually not going to bring it until closing. You're going to bring the money at closing. So you're going to pay the earnest money up front, and that'll be credited towards your down payment. So let's say that you're doing a $300,000 house and you're doing a 3% down payment program. So that's $9,000. Okay. So, but you put $2,000 earnest money in at the beginning of the transaction. So now the top part that you have to bring is $7,000 for the down payment. Okay. Then, and on top of that, somebody has to pay the closing costs. These are the fees that are generated by the need for financing and for need for a legal transaction. Closing costs include the appraisal fee, underwriting fees, any lender fees, discount points or origination charges. All of those are going to be on the financing side of things. When it comes to the legal side of things, you have intangible taxes and recording and title work and the attorney's fees. So all of those need to be paid for so that you can make sure that you are the owner and that the person selling you the house has the right to sell you the house, and then that it is properly recorded that you are now the owner. And then we'll also collect the money to start your escrow account, because remember, we have that to pay your taxes and your insurance and your mortgage insurance so that everything's protected on your home. Well, typically closing costs are about 3% of the loan amount. So if you're doing, again, a $300,000 loan where you've got a 3% down payment, so $9,000 there, 3% for closing costs based on the $291,000 loan amount. But for ease of calculations, we're just going to say another $9,000. Somebody has to pay those closing costs. Now, you can have it set up where you have the contract written that the seller pays the closing costs. You can pay the closing costs. Those are your options. If we do a down payment assistance, which we're going to talk about in just a moment, the down payment assistance can actually help pay for those closing costs as well. So that's pretty much how that works. And again, if you guys have questions as we're going through this, please plug them into the chat and we'll work on those after we're all done with the program. So down payment assistance programs. So there's multiple different sources that fund down payment assistance programs. And they're all going to have different options, different requirements, different rules about what, when they're going to give you money, how they're going to give you money, what that money is going to be used for, etc. So we either will have private down payment assistance, which is going to be through places like Regions Bank. But then there's also public places like Invest Atlanta or Atlanta Housing Authority, Fulton County Housing Authority, etc. They all have their own rules, okay? The Regions program is a grant. It's $5,000. You have to have a first-time home buyer in the transaction. We have an income restriction, and if the property is within a certain lower moderate income census tract, then we don't have an income restriction. So that's the rules, just real simple, basic rules on our $5,000 grant. When you get into other programs like Invest Atlanta, Atlanta Housing, Fulton County Housing, Gwinnett Homestretch, City of Canton, they're going to all have their own rules about what they want. Most of them are going to say it's a soft second mortgage, which means it's a second mortgage, but you don't have to pay a payment on it. Most of them are going to have a 0% interest on it, meaning that you're not going to be charged interest on the money. And most of them are going to be forgivable at some point in the future. Some of them are 5 years. I've seen them as high as 20 years. Programs that we offer, the highest is 11, which actually that's not even available right now. So the highest right now is 6 years. It's called an affordability period. What that means is that if you use their money for your down payment, then the first thing you have to do is stay in the home for that affordability period, 5 years, 6 years, 10 years, whatever it is. And as long as you live there in that home for that time frame as your primary residence, and you do not do a cash out refinance, if anyone else is having hearing issues, cannot hear me, please let me know. We had one guest that couldn't hear me, so hopefully she can hear me again. But if you have that second mortgage, if you have that down payment assistance, you do not have to pay for that interest because it's usually a 0%. And at the end of the affordability period of the 5 or 6 years, it's typically forgiven. Some of the programs will start forgiving a portion of it every year. And at the end of that 5 to 6, 10 years, whatever it is, then it's forgiven. But if you needed to sell your house, then in that time frame, then it could be that you are going to owe a portion of it, but maybe not all of it. And like I said, every program is different in terms of what they will allow and what they won't. So definitely when we talk about these options, I'll explain them all. If you have questions, I'll explain it again until you understand fully what it is you're signing up for. Mr. Diallo, I did notice that you have not muted your microphone, and I'm every so often seeing a flash. So I'm wondering if you mute your mic, if my voice will be a little clearer for you. Hopefully that'll work. So some of the action items you have to do when it comes to using the down payment assistance is you do need to have home buyer education. Almost every single one, actually they all do have home buyer education requirements. And if you were on the initial email that I sent about tonight's program, there was some information about home buyer seminars happening on Saturday and then next month through National Faith Homebuyers and through Catholic Charities of Atlanta. Those programs are homebuyer education programs that are approved by HUD or HUD counseling programs. And those programs are what they're requiring you to attend and get a certificate from. Those programs are typically 8 hours in length. The one on this Saturday will be 8 hours on Saturday. And the one that's done by Catholic Charities next month, they split theirs up on a Monday and a Wednesday night. And on that one, I will be doing the Monday night mortgage portion. So, but they do require home buyer education for these programs. The other thing they all require is a home inspection. Most of them require that you have a home inspection with of your own, which you're going to do most likely anyway during your due diligence time, and we just provide that report to them. Fulton County requires their own home inspection. They are going to send someone from the county out to inspect the property and make sure it's fully up to code. And as long as it's up to code, no issues. If it's not, they may require some additional repairs. So if we're going to be doing that down payment assistance program, we can just talk about that ahead of time. And then the little piggy bank there is to symbolize that even though you're getting down payment assistance and you're doing a minimum down payment program, it still means you have to have money into the transaction. The lowest amount that you have to have in these transactions of any of the programs that we offer is $1,000. So if you're buying your home inspection and you're buying the appraisal, that's $1,000 right there. But you also are going to have your earnest money on top of that. So we know you're going to meet that minimum requirement. Some of them go all the way up to $2,000. I think that right now the programs we're mostly focused on are $1,200 and $1,500 that you have to have in the transaction. And you do not get money back at closing, okay? Even if you put in more than $1,500, then we just lower other items on the transaction in order to zero it out, is what we say. I actually have one closing tomorrow. This young lady is buying a $197,000 house with a $150,000 mortgage. She is using our $5,000 Regions First Home Assist grant. That's $5,000. We just give it to her and she just walks away and never has to do another thing with it. $20,000 from Invest Atlanta and $25,000 from Atlanta Housing Authority. So by adding all of those, stacking all of those up, she's put in about $3,300 into the transaction between her earnest money, home inspection, and appraisal fees. And she is not bringing another dime to closing. She's actually zeroed out. So it's possible to make that happen. And that's how we would come up with that $50,000 that we talked about, is $5,000 from the Regions First Home Assist. And if you purchase property in the city of Atlanta, then you would get $20,000 with Invest Atlanta, provided you qualify, of course. And you could potentially get up to $25,000 with Atlanta Housing. So that's $50,000. That's how that works. And again, for some of you that have come in lately, if you have any questions during any of this, please feel free to just drop those questions in the chat and we will address those at the end of the presentation. So walking through the next steps here. So there's, you could say that there's 8 steps, 9 steps for the process, okay? So the first thing you're going to do is the loan originator is going to explain the process. Well, that's a lot of what we're doing tonight, is explaining the process. You have that initial conversation, which some of you have already had with me, 10, 15, maybe 20 minutes. Talk about, you know, your credit score, your income, your assets, some basic stuff. And then we decide the right thing to do next is to go ahead and do the application and provide those basic loan documents, W-2s, pay stubs, tax returns, bank statements, etc. You get that information over to you. I order the credit report and we review your loan options. These are your choices. This is how much you can afford. This is how much we would lend. You know, how does this look? Okay, we'll make this adjustment. How does it look now? Oh, I like it now. Great. Here's your pre-qualification letter. If we go through this bank orders credit report section and I review these loan application and documents that you provide, and if there's anything that I'm concerned about, if there's anything I'm not sure of with your income, then I will recommend absolutely that we do a pre-approval, because that will allow us to go ahead and get that underwriting in place. If you're under a tight time frame, I will also recommend that we do that pre-approval so that we can get you out shopping, get that house under contract, and get it closed quickly. Or if it's just something that, hey, let's go ahead and get you pre-approved, and then that way you don't have to worry about it. We can do that too. So if we go through the pre-approval, I'll send out those pre-approval disclosures. You'll e-sign those. You'll send the other additional documents that I want. And then we'll push the loan over to the underwriting and get that pre-commitment letter from the underwriter. If your loan looks great the way it is, then we'll just go ahead and issue that pre-qual letter. You take that to your agent and you start shopping, and everybody's getting excited because now the next step is to get that property under contract. So once we get it under contract, then we'll send you the actual application documents. We'll go ahead and request the appraisal while you're going through the process of paying the earnest money and getting the home inspection on your side. If you're doing down payment assistance, I'll send you a separate email with the documents for the down payment assistance and a list of all the items that we need for down payment assistance and for the loan itself. Once we gather those things, then we'll go to underwriting, get everything updated with the new information, work on all the conditions that we need to get, and then based on the contract terms of the property specs, then the loan decision will be rendered by the underwriter. Work on those conditions, get everything they're looking for: property appraisal, title work, homeowners insurance, questions about why your driver's license address isn't the same as your bank statement address, which isn't the same as the address you put on your application, things like that. Questions about those Affirm and Afterpay and Klarna transactions that are on your bank statement that you're going to stop doing, and make sure you know what debts you still owe on those or don't. And then we get a clear to close. And so once that is issued, once the clear to close is issued, then we get really serious, okay? Because now we know this is going to happen, okay? This is when you can start to get excited. So 3 days, at least 3 days before closing, we will send you an initial closing disclosure. And what that is going to look very similar to the mortgage fee worksheet and the loan estimates you're going to get early on in the process. But this will be updated with the actual title, the tax numbers from the title, homeowners association, once we've confirmed that between title and appraisal, the homeowners insurance that you have purchased, if you have flood insurance, that'll be added in there. And hopefully, you know, the earnest money, seller pay, closing costs, if they're doing any, will all be added in there so you can get a better sense of what the real numbers are going to be for what you need to bring to closing, if anything. Once that's done, then we'll send over the documents to the attorney's office. We'll finalize that closing disclosure, and then everyone goes to the attorney's office and meets. And that's typically when I meet you guys for the first time. So it's kind of a fun day. I go to all my closings unless some family thing is happening, because my family is first. But I do typically attend the closings. I rarely miss one. And we have a great time there, going through, signing the papers, answering all your questions, making sure you know what you're signing and that you're comfortable with it and that it's what you expected it to be. Once the signatures are done, we've already sent the money over. It's already sitting there in the attorney's office. Sign everything, and then that's the official transfer of ownership. You get the keys, and then you can go on your merry way. You are now a homeowner. And if you have questions in the future, you just call me up or you call up your agent and we'll get those questions answered. But you are now officially a homeowner. So by being here tonight, you're doing this. You are empowering yourself by taking the time to understand the common terms, your rights, what to expect throughout the mortgage process. And we also have in our website at Regions Next Step, which actually the website's not on here, but if you go to regions.com/nextstep, you can find all of these tools and resources, articles, calculators, webinars, worksheets, lots of different things, not only about buying a house, although we have an entire section about buying a house, but we also have a lot of these other sections as well, so that you can really get a good handle on your entire financial picture. And then, you know, again, homeownership comes with that initial and the ongoing costs, but it also comes with so many benefits for you and your family and the community at large. And so that's why for me, this is truly a mission, is to help people who want this to happen for them and to help them see that it can happen. And this is the way we do it. And we'll make a plan and we'll make that happen for you. So congratulations. Today you're leaving with the pros and cons of owning a home, basics about mortgages, what you need to know before buying a home, what's involved in the mortgage application and closing process. And of course, we discussed down payment options as well. So thank you so much for participating in this webinar. I appreciate you being here today. This is my email address here, as well as my cell phone number here. It is the only number that I use. So if you have questions and it's something you don't necessarily want to put into the chat, you can text me or email me or call me and we can discuss your situation in particular. So any questions, this would be a great time to bring those up and have that conversation.
Hey, Jen, I was trying to write my question in the chat, but it kept giving me an error. But
Okay.
my question is about the DPA. So the D restriction, are you saying that it's for cash out refi only, or refi and cash out refi that then you would have to repay the loan? The grant?
It's for cash out refi only is typically the restriction. So typically you
Okay.
can do a rate and term refi where you're going to lower that interest rate and you don't have to go back and pay it. They'll resubordinate to a rate and term refi. Yes.
Okay. That's good to know, because I was like, wait, hold on.
Yeah, no, that's an important distinction. No, absolutely. Because right now with the rates being a little bit higher, it is important to have the opportunity to refinance without having to wait 5, 6, 10 years, depending on those affordability periods, because who knows what the rates are going to be in 5, 6, 10 years, right? So absolutely. What other questions? Absolutely. I'm so glad to see you here, Dominique. It's been a minute. We need to grab coffee and catch up.
Yes, ma'am.
What other questions? It looks like Mr. Diallo is typing. Any other questions? Oh, no, guess he's not. Okay, for the 50K, we have to find a house in Atlanta City only. Yes, and you have to be qualified in income calculations. So every one of the down payment assistance programs does have an income restriction component. So when you send your loan applications to me and we go through them, if we have talked about down payment assistance or the potential need for it, then we will, I will assess that when I go through your documents as to whether or not you could qualify. The income limit is different for every program. So I hate that I can't just say a number to you and you just know it, but every single program is different. So for example, on the Regions First Home Assist, the $5,000 grant, the income limit is for the entire household. It's $82,800 per year, unless the property is in a lower moderate income census tract. If the property is in a lower moderate income census tract, then the income restriction is waived. There's no income restriction. However, for the city of Atlanta, for the Invest Atlanta and the Atlanta City Housing Authority, those income limits are different. They do something more, they do it based on household size. And they will look at first, they'll look at if there's children in the household, anyone under 18 or over 18. They'll look at if there's someone disabled in the household or not. And they'll look at child support payments, spousal support payments, and things like that, where we are not required to have that information for the loan. You may be required to disclose that information for the down payment assistance portion. So there's that. With the City of Atlanta and the Invest Atlanta programs, the property does need to be inside the city limits of Atlanta. So that's not going to mean necessarily that the address of the property is Atlanta, because some of the addresses are not inside the city limits. And if you go to the Invest Atlanta, it's just investatlanta.com website, and you choose that you are a home buyer looking for home buyer programs or down payment assistance programs, and then you go to item number 4, you can click on that and find check an address, and then you can type in the address and it'll tell you whether or not it's in the city limits. Okay. For the Fulton County housing, they have their own income limits that are different than the ones for Invest Atlanta, which are different than the ones for City of Atlanta, which are different than the ones from Regions First Home, which are different from Gwinnett Homestretch, which are different from City of Canton, because everybody wants to have their program their way. But for the Fulton County program, you can purchase a home inside Fulton County, but not inside the City of Atlanta, the City of Sandy Springs, the City of Roswell, and the City of Johns Creek. So anywhere else inside Fulton County. And the reason those cities are pulled out and excluded is because they have the funds that come into Fulton County for this program are federal funds, and it comes through a specific program. And so those cities get their own money from the feds through that program and then disperse it in the way that they see fit for their city and community. And so then it would be double dipping for Fulton County to access the money that way. So that's why they exclude those particular cities. So anywhere Fulton County except for City of Atlanta, City of Sandy Springs, Johns Creek, and Roswell. Anywhere else you can use it as long as you qualify. The Gwinnett home stretch, those are also income related, and it's anywhere in the city of or county of Gwinnett. The other thing with some of these programs, Gwinnett has one of the lowest ones, I think, is they will max out what your purchase price can be. So I think that the Fulton County one is $332,000. So let's say that you found a house for $335,000, it's a perfect house, you're planning on using Fulton County. You can't pay $335,000 for that house. The most you will be allowed to do is $332,000 or whatever that year's maximums are. So that's something else to be aware of when you're choosing if you want to use any of those programs if you qualify. Really long answer to the income question, but unfortunately there's not a simple answer. Any other questions that we can get for you guys tonight? Thumbs up, must have gave you the right answers then. Awesome. Does anybody else have any other questions?
I did have another question. So what is typically like the time frame this will take? If you're going to do one of these programs. So once you get the class that you were talking about, like on Saturdays with the 8-hour class, right? So is there an expiration date for that? And then after you do that, like, is there a time limit to any of this stuff before
Yes.
you actually get to close it?
Yes. So for the home buyer education courses, once they give you that certificate, it's good for 12 months. So hopefully that's enough time for you to find the house that you're looking for. For the process, if you're adding down payment assistance to the process, it doesn't typically add much time at all, maybe a week. It depends on which program. Okay. So for example, the loan that I talked about that is closing tomorrow, the product, that program, that loan package for the down payment assistance pieces, one was sent right at Christmas time, and the other one was sent the first week of January 5th. And we got the approval on that one 2 weeks later. So some of them are very, very fast, and some of them tell you right up front it's going to be a solid 3 weeks, if not 4. And so these are things that, as your loan officer and working in partnership with your agent, realtor, realtist, we talk about those things so that they know when they're negotiating a contract for you. Okay, Mr. Diallo is doing a down payment assistance program, so we need to make sure, because of the program that he's doing, that we allow enough time for having those things included. So if we do the pre-commitment, pre-approval, so that you have a commitment letter in place, and we know for an absolute that you're going to be using a down payment assistance program, there are certain things that we can set up ahead of time, but none of the down payment assistance programs will allow me to reserve funds or to start a process with them until we actually have a contract and a property, because they're all geographically based. And so then they're like, we're not going to talk about it until we we know you're buying in our geographical location. So does that answer your question?
Yes, thank you.
You're welcome. Any other questions, comments, suggestions? Well, if there isn't anything else, then I'll just tell you all, thank you so much for choosing to spend your Wednesday night with me. It was great to see that each of you were here. I appreciate it. Cynthia and Tiffany, I know I owe you some information. I promise I'll get there. I'm working on it. I think I've got a couple of emails from each of you that I need to go through. So not purposely ignoring you. I'm working on it. So, but thank you everyone for being here.
Thank you.
I think the rain has started here. Either that or someone's taking a shower behind me in my bedroom.
All right, thank you. I'll call you for some additional detail.
That sounds great. Thanks for being here.
Yeah.
And if you have all the information you need, feel free to drop off. I will stay here until everyone else is gone. Thank you again for coming. I appreciate it so much. And Trish, you and I need to get together. We need to have some lunch or something, maybe some margaritas.